Picture this. The world's biggest debtor, the United States, leans on its closest friends to keep swiping the credit card. And now one of those friends is finally slamming the wallet shut. Today we zoom in on Washington's high-pressure campaign against Tokyo, why Japan just muttered "no more," and how that single word could yank the dollar off its throne. Stick around. The twists are wild, and the stakes are straight-up terrifying. First, the squeeze. America's current account gap is running near 3.8% of GDP, about $1 trillion a year. To plug that hole, Uncle Sam needs a fire hose of overseas cash, mostly via Treasury auctions. Trouble is, the foreigners who once gobbled up those bonds are losing their appetite. At the last 30-year auction, domestic buyers had to cover for foreigners, and they still managed only 14%. Its worst showing in 6 months. Dig into the Fed's custody data, and it gets uglier. Foreign central banks have dumped U.S. securities to lows not seen since 2017, choosing gold, euros, even yuan instead. They're calling it de-dollarization, but it feels more like a slow-motion bank run on the greenback. Why the cold feet? 1. Washington's sanction hammer makes 85% of reserve managers nervous about holding too many dollars. 2. Ballooning deficits, set to swell another $3 trillion within months. Raised doubts about ever getting paid back. 3. The dollar itself is wilting, down double digits this year, slashing foreign returns. If absentee foreigners become permanent no-shows, the Fed will be forced to buy its own IOUs, print more money, and risk turning a soft dollar into a shredded one. Higher yields, pricier imports, and an inflation firestorm could follow fast. Enter Japan, America's second-largest creditor, sitting on roughly $1.1 trillion in treasuries, but nursing its own headaches. Tokyo's economy just shrank 0.7%. Exports and household spending are flatlining. Auto giants like Toyota are reeling from fresh 25% U.S. tariffs, erasing billions in profit. Under that cloud, the White House lands an ultimatum. Jack up Japanese interest rates, strengthen the yen, make your cars costlier, or we'll wreck you anyway. Translation: torch your own economy so ours doesn't have to diet. Problem: Japan's debt mountain is Everest high, about 236% of GDP, and the Bank of Japan already owns 4/5 of government bonds. After scrapping yield curve control last year, long-term yields spiked to levels unseen since the 90s. Another hike could blow a crater in the BOJ's balance sheet and send shockwaves through global markets. Deutsche Bank claims the yen would need to surge 20 to 25% to satisfy Washington. That would annihilate exporters, slash wages, and shove Japan toward a deflationary abyss. No wonder BOJ officials whisper about delaying any tightening until at least late 2025. But here's the plot twist. Japan isn't just digging in, it's loading ammo. Behind closed doors, Tokyo hints it could unload a chunk of its treasury hoard. That threat alone rattled Wall Street last April. A real sell-off could rocket U.S. rates, crush the dollar, and freeze credit worldwide. Finance Minister Kato originally swore off weaponizing reserves, then quietly walked it back. All options are on the table. Markets heard the klaxon loud and clear. While Washington bickers internally, Treasury, Commerce, and USDR can't even coordinate their talking points. Japan is forging new trade escape routes. Shipments to fellow CPTPP members are surging, deals with the UAE are multiplying, and car exports to Mexico and Canada now shoulder the growth America once enjoyed. In other words, Tokyo is future-proofing, and every new contract signed outside the U.S. chips away at American leverage. Back home, Prime Minister Ishiba faces a make-or-break upper house election on July 20th. Voters are furious about tariffs, a plunging yen, and stagnant wages. He must prove Japan won't be bullied or risk losing power. So expect bold moves, stealth currency interventions. Tokyo's done it before. Sweetheart investments on U.S. oil to buy goodwill. And yes, the nuclear option, selling treasuries, if the White House keeps twisting the knife. Here's the nightmare scenario. Japan dumps bonds, U.S. yields spike, the Fed scrambles to print dollars, inflation explodes, and global investors run from the greenback en masse. Suddenly, that trillion-dollar annual deficit can't be rolled over cheaply. Social security checks get lighter, and America's post-war financial dominance cracks. All because an ally decided survival mattered more than loyalty. Could cooler heads prevail? Absolutely. The U.S. could curb its spending binge, the two sides could scrap car tariffs, and both could pivot toward a balanced Pacific partnership. There's hope in diplomacy, if it shows up in time. For now, though, we're teetering on the edge of an economic cage match that neither side can easily win. So, will Tokyo really pull the trigger? Will Washington blink first? The next bond auction, the next tariff headline, even a stray comment from a BOJ governor could flip global markets overnight. Keep your eyes glued to Global Pulse. The aftershocks are just beginning, and you'll want the full story before it hits your wallet.